Have a company joining us with their numbers. It was an operationally weak quarter from HomeFirst Finance, the stock that just recently listed, but lower provisions have helped sequential profit after tax growth. Manoj Viswanathan, Managing Director and CEO at HomeFirst Finance, joins us now. Manoj, good morning. Thank you very much. You know, what we have are your quarter-on-quarter numbers, your disbursements at 348 crore versus 243 crore. Now, obviously, quarter-on-quarter will be higher because second quarter was partially locked. Can you give us a year-on-year growth figure for disbursements or AUM or even AUM?
So year-on-year, so last year, same time, we had disbursed about 1,200 crores. And so this year, most of the disbursal happened in the third quarter. So we are at about 650 crores. But on the AUM side, we have grown by 16% year-on-year, compared to last year. So the AUM growth is still going well. And disbursements have also come on stream. So if you look at December disbursals, they have been higher than our last December disbursals. And same for January. So, first two quarters, of course, the disbursements were lower. But now we have come on track and the disbursements are, higher than the previous year's disbursements.
So now I will come to the more important question of asset quality. You'll have declared a gross NPA of 1.6%. What was that year ago? And more importantly, how much of restructuring requests have you got? What amount?
Yeah, so on the gross NPA side, again, this is the pro forma NPA, including the portion that is in stage 3 and which can't be declared as NPA. This is the total stage 3 assets that we're talking about. So 1 year ago, we were at about 1%. So there's an increase of about 60 basis points. And this is something that we had expected, on account of the pandemic. But all other indicators are fairly strong. So our bounce rates, that is the check presentation bounce rates, have been declining quarter on quarter. And our collection efficiency has been going up again month on month. So if you see our last 3 months collection efficiency, they have been pretty strong and, improving on a month on month basis. As far as restructuring is concerned, ours is a, housing finance business with customers having long-term, 10 to 20-year kind of loans. So restructuring requests have really not come, and they don't actually make sense for the customer also. Because even if they restructure the loan, their installment will reduce by hardly 100 or 200 rupees, which will not really help them to repay the loan. So we have hardly had any restructuring requests.
The 30 days past due number is shot up quite a bit. It's 4.1% of your book.
That's 30 DPD number?
30 days past due?
That's right.
Isn't that at 4.1%?
That is exactly right. And then that is again something that we expected on account of the pandemic, because there was a moratorium till August, and from September customers really kind of reconciled to start paying their installments. So there are a few customers who have missed 1 or 2 installments and they are kind of stuck in the 30 days past due. So they are trying to catch up. They will catch up over the next few months. But for the time being, they are paying 1 installment and they are stuck in that 30 to 90 bucket. These are not chronic defaulters who are going to end up end up as NPAs. They are more like temporary temporary defaults where customers will try to catch up in the next few months.
So, as some of these things normalize, Mr. Viswanathan, do you have adequate buffers built up? Because now this, 30 days past due number right now looks a little alarming. I guess you'll see how many of them pay up and how many of them start slipping. So some projections would be helpful.
Yeah, so we have, we have actually been right from March itself, we have been, creating a provision buffers. And so if you look at it, we are, our provisions as a percentage of the total on-book pause that we have is about 1.4%. In, pre-COVID times, that number is more like about 60 basis points. So we have actually provided more than sufficient buffer for any slippage that can happen. Similarly, if you look at the coverage, the provision coverage ratio, we are at about 90%. So almost 90% of the stage 3 assets have been provided for. So we have more than sufficiently provided for any kind of slippage that is there, and we don't anticipate anything very severe from here onwards.
Okay.
Because we are seeing all other indicators improving on a month-on-month basis. So our bounce rates are decreasing month-on-month. Even this 30 DPD, like I said, is a temporary issue. And customers keep catching up, that number will keep coming down.
What is your cost of funds now?
So cost of borrowing on a total, on the total book is about 8%.
Incrementally, is it going up?
No, it is right now we are on a declining, on a declining trend. Compared to say 1 year ago, where we were at about 8.4, 8.5%, we are down to about 8%. So to that extent, our spreads have also improved.
But inherently, then you will be picking risky customers, isn't it? Because the going rate for home loans is like 7%, even lower in some cases. SBI called a press conference to declare that they have a 5 lakh crore book. So if banks are going to give at 7% and your cost of funds is 8%, you're not really competitive. So you have to pick risky customers.
No, so inherently we are in a segment, which is the affordable housing segment, where customers have a different set of requirements. Primarily, one is that they want their loan to be approved fast because they are all in day-to-day jobs, and if they cannot take off too much time from their work to go and apply for a loan in different places and so on. So quick turnarounds is something that they need and that we provide. Secondly, these are all customers who are working in small firms, where they find it difficult to provide all the documentation that the larger lenders need, and we are able to provide that extra counseling and the extra effort that is required to you can say assess the income of these customers. So somebody who's working in a small firm, he's probably not getting his salary slips. He may be getting his salary credit in his bank account, but he may not be getting all the documentation that is required for a larger lender. So that is where we come in. We have to assess his income properly, give him the right amount.
Sure, sir, got that. Thanks very much for joining in and giving us some color on the business at the end of the third quarter. Nishal, before we